Welcome to our webinar today on Colorado small business tax strategies. If you're one of our regular webinar attendees, welcome back. If this is your first time joining us for a webinar, then welcome. Our goal is to help you find ways to maximize your tax deductions and credits by using Colorado and federal laws and regulations to your advantage. Now, a few quick housekeeping items to get us started. Please send us your questions as we go along using the Q&A button on your Zoom controls rather than the chat button. We'll answer questions as we go along, make sure you get the most out of our conversation today and clarify any questions that come to mind. And finally, we'll be sure to share a recording of the webinar and the slides with everyone after we've finished today. A quick introduction for me, I'm Colby Davis. I'm president of ObsidianHR. I've worked in government in a couple different industries before I started working in HR outsourcing. I love working with business leaders and feel especially lucky that I get to work with small business owners on a daily basis. ObsidianHR helps businesses streamline and simplify their HR by solving problems in HR, payroll, benefits, compliance, and more. Now for the more important introduction, we're joined today by Lisa Bring from ClearPath Fort Collins CPAs. She's a CSU graduate, go Rams, and has been working in public accounting for over 15 years. She's a CPA with deep experience and expertise in Colorado tax law and is an incredible resource for her clients who are small business owners, just like many of you. ClearPath Fort Collins CPAs works closely with small businesses to navigate tax planning and compliance. They provide CFO advisory services, entity structure analysis, business succession planning, IRS notice resolution, litigation support, and more. Definitely a great partner that you want to have in your back pocket when you run into any of the issues that we run into as business leaders. Here's our agenda for today. We'll first talk a little bit about the Colorado tax landscape at a high level, just to make you aware of some key information there. Then we're going to talk about business deductions. This is really all about how you decrease your taxable income. Then we'll talk about Colorado and federal tax credits. This is about how we can reduce our total tax liability. Finally, we'll hit on some important points about tax planning and record keeping. And we'll end by addressing any other questions that have come up along the way. Just to kick us off and for a little fun, inspiring quote that certainly is applicable for our discussion today. And and with this fun note, Lisa, I will turn it over to you so you can walk us through the overview of the Colorado tax landscape.
Great, thanks, Colby. I really like that quote too. I often joke that if they ever made the tax law simple enough to put me out of a job, I would happily find something else to do. But seeing as the tax law has only become more difficult, especially 7 years ago, I don't think that's going to happen. So, yeah, I'm going to go ahead and jump right into Colorado. Oops, sorry. Gotta get the, okay, right, there we go. So Colorado business owners have many types of taxes they might need to pay. We have income taxes, payroll taxes, sales and use taxes, lodging taxes, personal property taxes, excise taxes, heavy highway and vehicle use taxes. That is a lot of tax payments and paperwork for small businesses. For income taxes, Colorado has been aligned closely with federal law for many years, but recently they have started diverging more and more from federal, making it more complicated with additional adjustments needed. This also makes it more important to have a tax plan to fully take advantage of deductions and credits available to your business. And we're going to give you an overview of some of the more complicated or underutilized deductions and credits today. First, though, along the lines of the various tax types are the various tax filing deadlines. Income tax deadlines for 1040s, which are going to include sole proprietorships, and C corporations are April 15th and October 15th for the extensions. S corporations and partnerships, which are pass-through entities, are due a month earlier on March 15th and September 15th for extensions. Generally, these types of businesses don't pay taxes, but pass through the income to the owners on Schedule K1, and the owners pay the taxes instead. This is why the deadline's a month earlier. We will be discussing one of the reasons a pass-through entity would pay taxes a little later on. And I want to clarify a couple misconceptions regarding extensions. Extensions do not extend the due date of the tax payment, only the time to file, and they do not increase your risk of audit. So if you don't have everything together by the first deadline, go ahead and file that extension. Some other deadlines, we will discuss estimated tax payments a little more later on, but those are due quarterly on April 15th, June 15th, September 15th, and January 15th. Payroll taxes are due at the end of the month following the end of each quarter. EFTPS payroll tax deposits are due based on your payroll size and filing schedule. It's the 15th of the following month for monthly depositors, or within a few days of the pay date if you are a semi-weekly depositor. And sales and use tax returns are generally due the 20th of the month following the end of the period, but this can vary by jurisdiction. There are over 2,000 sales and use tax jurisdictions in the country, so it's best to check with the ones in which you have nexus to check your filing requirements.
Quick question for you, Lisa. Do
Yep.
extensions accrue interest and penalties?
Yes. If the amount of tax that you ultimately have to pay, you just didn't pay enough with your extension, yeah, that's going to accrue interest and penalties until it gets paid. It's just late filing penalty, late interest. So do your best to make those extension payments when you file your extension.
Okay, but one more question. Nexus, that's a word we hear a lot when we talk about taxes. Could you just define that for us and help us understand how it applies to us?
Yeah, so nexus basically means you've had a certain amount of contact with the jurisdiction, which triggers a filing requirement. So especially with sales and use tax lately, with all of the online sales, that gets tricky because a jurisdiction says, hey, you shipped to me, you owe me sales tax. As far as income taxes go, generally you still have to have a physical presence, but even that's starting to get a little murky. So yeah, definitely if you are doing business out of your home state, go ahead and check those filing requirements to see if you've had enough contact with the state that you have a filing requirement.
Okay, thank you.
Okay. Right. So tax avoidance is illegal, but we can go with tax reduction strategies. And that's kind of what we want to focus on next. Moving on to the deductions available for your business. We'll start with the qualified business income deduction. This was created in 2018 with the Tax Cuts and Jobs Act, and it's set to sunset at the end of 2025. But with the upcoming elections, it may or may not be extended. We will have to see how that goes. The deduction is 20% of your qualified business income, or QBI. I'm not going to go too deep into how QBI may differ from your net business income, but I will say guaranteed payments in a partnership are not qualified business income. We have some legitimate shifting between guaranteed payments and distributions in a partnership as a tax planning strategy that we often utilize with our clients depending on their situation. When the taxable income on your 1040 is above a certain amount, the QBID is phased out for a specified service trade or business, and it may be limited for other types of businesses. Above 483,900 for married filing joint and 241,950 for the other filing statuses, the QBID is limited to 50% of wages paid by the business plus 2% of qualified depreciable property. This is another planning opportunity. We have had clients pay themselves year-end bonuses of $200,000 because they didn't otherwise have enough wages paid to take full advantage of the QBID. And the additional payroll tax cost was far less than the tax savings from taking the maximum qualified business income deduction.
Hmm.
Also related to tax law changes from the Tax Cuts and Jobs Act, we now have available the Colorado pass-through entity tax election. The TCJA limited the state and local tax, or SALT for short, that can be taken on Schedule A itemized deductions to $10,000. A lot of the states have come up with workarounds to allow for the deduction for at least some taxpayers anyway. And Colorado's solution was the pass-through entity tax election. This election allows pass-through entities to choose to pay Colorado taxes instead of just passing through the income to the owners. It still passes through, but then this tax payment is a credit on the personal tax return and is a federal tax deduction on the business tax return in the year in which it's paid. The catch is, if you make this election, you must add back the qualified business income deduction from the federal return to Colorado taxable income. So this election truly only benefits taxpayers who are above the 24% tax bracket. This election also makes it necessary for the pass-through business to make estimated tax payments throughout the year to avoid estimated tax penalties. The next business deduction I want to discuss is employee wages and benefits. Everyone knows wages are a business tax deduction, but I want to emphasize to the S Corp corporation owners, you must pay yourselves a reasonable wage. You cannot determine you can determine a reasonable wage using the Department of Labor Resources or any other reasonable method, but you got to do it. If you don't, the IRS will reclassify probably all your distributions to be wages, and then you will owe not only the payroll taxes on the reclassified amount, but interest and large penalties as well. It is much better to split your cash out of the business between wages and distributions yourself. On the benefits side, a lot of small businesses are not required to provide benefits, but may want to do so anyway to stay competitive in the job market and attract talent. Many benefits also have special beneficial tax treatment to encourage employers to provide them for the employees. First major benefit I want to talk about are retirement plans. Starting last year, Colorado Secure Savings Program went into effect. All businesses that have 5 or more employees and have been in business at least 2 years either need to have a retirement plan or need to facilitate the Colorado Secure Savings. There is no cost to the employer to use the state plan, and it allows your employees to contribute to a retirement plan. If you do choose to sponsor a retirement plan of your own, the cost of the plan is a tax deduction. You can choose a traditional plan, which allows employees, including yourself, to put away tax-deferred earnings now, or you can choose a Roth option. Depending on the type of retirement plan you choose, the plan administration can be simple or complex. And this is where you might want to decide you want to sign up with a professional employer organization or PEO to ease the administrative burden. There are far too many types of retirement plans available to go into detail, but the IRS has a good summary at the hyperlink on the screen if you want to take a look into this further. And I think Colby mentioned we'd be sending out this slide deck after the fact, so don't worry about scribbling that down.
Lisa, I'm curious, going back to the retirement plans, I've heard mixed reviews about the process of working with the Colorado Secure Savings option for employee retirement plans. It's nice because it's there and it's easy and it can be automatic. I've also heard clients mention that your investment options could be limited for employees. It doesn't feel like you have the same kind of variety or number of options that you might have if you're able to choose your own plan. What are you hearing from your clients about CSS?
No one has mentioned anything regarding the investment options. We only have a couple clients who actually went with the Colorado Secure Savings. A lot of them have their own retirement plans set up in another manner. But yeah, I suppose if that is the case, it might be a better option to go with another plan. But I suppose even then, depending on what you go with, you might still be limited. So it it's probably good to take a really good look at what your options are as you're setting that up, and maybe check around if you feel that it's too limited based on what you've seen.
Fair enough. Fair enough. Thanks.
Yeah. All right. There we go. All right, the next major benefit employers offer is health insurance. Obamacare requires that everyone have health insurance, and employers with 50 or more full-time equivalent workers are required to offer health insurance to employees. For smaller employers, this isn't required, but it's still a good idea to attract quality employees. Again, the administration of health insurance can be burdensome to small businesses, but this is another area where a PEO, like Obsidian, can take away the administrative burden, as well as offer some additional cost savings compared to other small group plans. The next deduction I want to talk about is depreciation expense. Large assets with a useful life of 1 year or more that are not held for inventory are required to be capitalized and depreciated. Businesses can make de minimis safe harbor election each year to expense assets that cost less than $2,500. And the purpose of this is, again, to ease administrative burden. If you're in an enterprise zone, you might not want to make this election, but we'll get to that a little later. The IRS specifies the asset life under the Modified Accelerated Cost Recovery System, or MACRS, in case you're ever wondering how your accountant came up with the asset life. There are a couple of special options aside from the de minimis election to take more depreciation in the first year the asset is placed in use. 179 depreciation allows you to take 100% of the depreciation in the first year on assets up to $1,220,000 in 2024, and this total amount's adjusted annually. The limitation on 179 depreciation is that it cannot be used to reduce business income below zero. This is another deduction business in an enterprise zone might not want to make, but again, we'll discuss that in a bit. The other special depreciation is called bonus depreciation. For many years now, bonus has been 100% depreciation in the first year, and it can be used to reduce taxable income below zero. It has started phasing out, so in 2024, it's down to 60%. And over the following years, it'll be reduced 20% each year until it's zero in 2027. Unless, of course, Congress decides to extend it again, which may or may not happen. It's, got to get out the crystal ball. Who knows? Bonus is automatic unless you elect out of it.
One question, Lisa, going back a few slides to the qualified business income deduction, what is a specified service trade or business for the QPI deduction?
Yeah, so the quickest way to put it is it's white collar workers, lawyers, accountants, financial advisors, doctors, dentists. I want to say that real estate agents were able to get a specific pass so that they weren't qualified as this. But yeah, it's mostly think white collar workers for specified service trade or business.
Okay, thank you. That's helpful.
All right. Any questions before we move on to tax credits?
I think that's it. So let's jump in. Colorado tax credits.
All right. The first Colorado tax credits I want to talk about are grouped under enterprise zone tax credits. To qualify for these credits, your business needs to be located within an enterprise zone. These zones can vary a bit from year to year, so especially if you're on the edge of a boundary, you might want to check the map each year to see if you might qualify for the credits. So Colby, if you want to help me out with going to that link on the screen so that we can take a look at that map. So this is the enterprise zone map, and it's pretty easy to use. You just start typing in your address. I'll go with ClearPath's address. And it's best to select something that's auto-filled. It works a lot better. So as you can see, ClearPath is actually on the edge of one of these boundaries. We've got a residential neighborhood across the street from us. So that's why it doesn't extend. One thing you need to take from this map, once you see that you're in the boundary, it will tell you which enterprise zone you're in. And you're going to need that when applying for the credits. So, all right, Colby, if we could go back to the slides. So once you've determined you're in one of the zones, you have to pre-certify before the qualified activity takes place. This is done on the same website where we were just looking at the map. Generally, we just pre-certify all our enterprise zone clients before January 1st of each year to make sure all the activity for the year is qualified. If you don't end up having qualified activity for the year, you don't need to worry about doing anything else. But if you do have qualifying activity, you would need to then apply for certification using the same system. Once you're approved, you attach your certification to your tax return where you are claiming the credit.
So Lisa, I thought this was a really interesting point. You don't know that you're going to have anything, you got to pre-certify ideally before January 1st, say
Yes.
2025. So that does take some forethought, and
Yep.
you want to be working with your CPA or tax professional to make sure that you're able to claim that if you do have qualifying activity. Is that a fair understanding?
Yes. And, back getting to the point where I'm starting to feel old, back 12 years ago, maybe more, you didn't have to pre-certify. You just claimed it with the tax returns. Then they started the pre-certification, and I'm betting a lot of people are missing out now because they either don't know to pre-certify or they forget, or so like I said, if you're in an enterprise zone, you should just pre-certify because there's absolutely no harm, and then you might get a credit if you have the qualifying activity. So what are these available credits? There's 8 available, designed to encourage economic growth and development in the enterprise zone. The new employee credit is $1,100 per net new employee. Health insurance is $1,000 per net new employee for the first 2 years the business is in the enterprise zone when the business offers health insurance. Job training is 12% of eligible training costs for employees working in the enterprise zone. The investment credit is 3% of business personal property investment. This is the credit I was mentioning earlier when we were going over depreciation. To qualify for this credit, the asset has to be capitalized and depreciated. If you make the de minimis election or take 179 expense on the asset, it doesn't qualify for this credit. In a lot of cases, it's better to take 3% credit and let the depreciation expense be spread out over several years, rather than taking all the expense the first year and not getting the credit at all. Then we have Colorado Research and Development Credit, which is 3% of the increase in R&D expense compared to the prior 2 years. The Building Rehabilitation Credit, which is 25% of rehabilitation costs, up to $50,000 in credits for buildings that have been vacant for at least 2 years. The commercial vehicle credit, which is 1.5% of the purchase price for commercial vehicles used in the enterprise zone. And the sales and use exemption for manufacturing and mining equipment, which expands the statewide sales tax exemption for this equipment to include non-capitalized equipment and parts.
Lisa, a couple questions for you. What types of expenses qualify under job training?
So if you bring in a trainer, that will qualify, just some outside consultant, or I believe webinars should qualify, just pretty much anything required to get the employee up to speed. But it's, if you're doing internal training, you might be able to deduct or take a credit on any cost of materials involved with that training. but you're going to have a lot harder time claiming the credit. So it's mostly you have a third party training your employee.
Okay, so external costs are the easiest way to be able to claim that.
Yes.
What about the commercial vehicles? It says used in an enterprise zone. What if your business is located in enterprise zone, but you mentioned there's a residential neighborhood across the street from ClearPath CPAs, and your service vehicle is going there to, fix someone's HVAC, for example. Does that still qualify, or does it have to be used, mostly in the enterprise zone?
That does get trickier. My understanding was it needs to be used within the enterprise zone. So a delivery vehicle, probably not. I'm kind of thinking along the lines of maybe some construction equipment. We haven't actually had any clients try to claim this one because it is more difficult with vehicles. We look at them for the investment credit and then disallow it because the vehicles do leave the enterprise zone. So, um, I
So,
might have to do a little bit more research to get a better answer than that, but it does get trickier with vehicles.
but another reason why a person like me doesn't want to be making these determinations on their own, because there's a lot of nuance here.
Yep. Yep, for sure. And, even doing these as long as I have, a lot of times I'll still go back and double check and research just to make sure that I'm remembering correctly because it does get tricky. And we want to make sure we're doing it right.
Yeah, for sure. For sure. Thank you, Lisa.
The other Colorado specific tax credit I want to go over is geared towards larger businesses. The job growth incentive credit. This is up to 50% of FICA per net new job. The eligibility requirements are that the business creates at least 20 net new jobs in the year in Colorado. The business had considered at least one other state or international market for the job creation, and the business acknowledges receipt of this credit as a major factor in the decision to locate the project in Colorado. For the project to qualify, it needs to be that it could have reasonably and efficiently been located outside Colorado. There was a reduced probability of commencing the project in the state without this credit, and the business needs to have actively considered other states for this project.
One question, Lisa, is going back to the enterprise zone credits. How are net new employees calculated?
Right. So that is calculated by taking the number of employees at the end of each month and averaging them, add them up, divide by 12. And the increase year over year is that number. And you can take partial employees. So, if you average half an employee more than last year, you can take half of that credit.
Oh, okay. So that the vehicle one may be pretty stringent, but that actually sounds pretty generous.
Yeah. Yeah. I went into researching that a bit more a few years ago, and I was a little surprised at that. But yeah, they allow partials on that one.
Generous tax credits. Love it.
Yeah.
Rare thing.
Yeah. Any other questions on the Colorado before we move on to federal?
Looks like we're good. Let's jump into the federal.
All right. The first federal credit I want to cover is the tips credit. This is for businesses in the food and beverage industry with tipped workers and is meant to encourage businesses to make sure all tips, including the cash tips, are reported appropriately for payroll. The credit is 7.65% of tips reported on the W-2s, which is basically the employer portion of FICA. Qualified tips are those above what is needed for the employee to meet federal minimum wage. Federal minimum wage this year is 7.25, and the Colorado tipped minimum wage is $11.40. So this is not a relevant limitation for Colorado tipped workers. But if you're in a state following federal minimum wage, you will need to take only the tips that are above 7.25 into account. For any employees making more than the Social Security wage base, which is $168,600 this year, any tips above this amount are also not qualified for the credit. Next, we are back to tax benefits for starting a retirement plan. The retirement plan startup credit is up to $5,000 per year for 3 years for the cost necessary to start a qualified retirement plan. To be eligible for this credit, you must have 100 or fewer employees who received at least $5,000 in the preceding year in wages, at least one plan participant who was a non-highly compensated employee, and in the previous 3 years, your current employees are not substantially the same employees who participated in another qualified plan sponsored by you or a member of a controlled group that includes you. Basically, you can't start a business, take the credit, then shut down that business, start a new one, hiring all the same employees, and take the credit again.
Sounds like a lot of work to do that anyway.
Yeah, but I mean, heck, if you can save some taxes, I could see somebody trying to go after that. So they did close that particular potential loophole. The next credit, I think a lot of businesses miss out on because of the upfront paperwork. I know I haven't seen the work opportunity tax credit taken on very many tax returns I've prepared, because if a business owner didn't provide us with the paperwork showing the credit eligibility, even if they had an otherwise qualified hire, it is way too late when preparing the income tax returns to do anything to take the credit. The work opportunity tax credit's been around for many years, I think starting in 1996, and has been modified or extended many times since it was first created. It's currently set to expire at the end of 2025, but it's possible it'll be extended again. Get out that crystal ball to find out on that one. The credit is currently 40% of wages paid to a qualified individual, up to $6,000, with the total credit being $2,400. Although certain qualified individuals, you can actually get a credit as high as $9,600. A qualified individual needs to be in their first year of employment with you, be a member of a targeted group, and perform at least 400 hours of service for the employer. The targeted groups is a fairly long list that you can find on the website for work opportunity tax credit. But some of the groups include qualified veterans, qualified ex-felons, qualified summer youth employees, qualified SNAP benefit recipients, and qualified long-term unemployment recipients. For the employer to get this credit, pre-screening and certification that the employee is qualified must be done at the time of hiring. And the paperwork needs to be sent to the state workforce agency to complete certification. Procedures vary a little by state, so it's best to see how the state wants the paperwork to be submitted. From what I'm seeing, a lot of them are wanting it submitted electronically within 4 weeks, 30 days of the person being hired.
Yeah, Lisa, I'll just echo what you said on this one. WOTC, as we affectionately call it, is a lot of paperwork, and it can be great to get those checks in the mail, but it can take months, very, very long time to actually have that tax credit show up. So yeah, best to work with a third party who specializes in this, or has the tools, capabilities integrated into how you operate, so that you don't have to worry about it as a business owner, business leader, because it can be very time consuming trying to do it on your own.
Yep. The final credit I want to discuss today is the Federal Research and Development Credit. This credit is 20% of qualified research and development expenditures. The alternative simplified credit is 13% of R&D expenditures, and no expense add back to taxable income is required when using the simplified credit, which is why you might want to use it. You kind of have to do an analysis to see which is the better deal. Qualified expenditures are those related to activities which are discovering information that is technological in nature. For example, engineering machinery, as opposed to, say, development of an article of clothing. You should be developing a new or improved business component, and the process involves experimentation to eliminate the uncertainty concerning the development or improvement of the product. For tax years beginning after December 31st, 2021, R&D expenditures must be capitalized and amortized over a 5-year period, or 15 years if the expenditures are for a foreign activity. Because a company just starting might not have any income against which they can apply the credit, qualified small businesses can take the credit against payroll taxes instead. A qualified small business means gross receipts of less than 5 million for the tax year, and they did not have any gross receipts before the previous 5 years. So again, that can be a beneficial one, but they made it a little bit painful to take it starting 2 years ago.
Question, Lisa, on the R&D credit. Can you still take the R&D credit if whatever you're working on trying to develop didn't work out?
Yes, they want to encourage companies to at least try, even if the product doesn't work out. Imagine pharmaceutical companies not being able to take this credit for all of their failed products before coming up with a successful one.
Okay, so that's good news. Good news for
Yeah.
all of us trying to pioneer something new or test out something new. That's really good to know.
Yeah.
No other questions on this section, so let's jump into tax planning and record keeping, everyone's favorite topic.
Oh, yeah. I mean, everybody's super excited about this one. Yeah. All right. Well, it might be a little bit boring, but it's important. So, with the tax law as complex as it is, tax planning and good record keeping are extremely important. We discussed a bit about tax planning opportunities as we went through the credits and deductions, but creating a budget for your business is a great first step each year. Not only does it allow you to set guidelines for how you expect your business to do throughout the year, and it allows you to analyze whether your operations are functioning as expected, and it allows you to analyze opportunities. Maybe this year where there's enough net profit to start that retirement plan you've been wanting to set up, or maybe there's a new piece of equipment you've been needing and your purchase of it can reduce your taxable income to a lower tax bracket this year. We strongly recommend quarterly projections for all businesses. We see this as important enough that our minimum level of services at ClearPath includes quarterly tax projections and estimated tax calculations for all new and most of our existing clients. It's very difficult to do anything to reduce the tax burden after the end of the year when the tax returns are being prepared. So it's best to look at the situation periodically throughout the year to determine what steps the business can proactively take to minimize tax liability and meet your financial goals.
So you're
It's
saying
all,
we
yeah.
shouldn't wait till April to figure this all out for the
No, by then it's kind of too late. You can do an HSA contribution, IRA contribution, and that's almost it. um, so yeah, definitely want to do that during the year, not after the fact. It's also important to make the estimated tax payments if your wage withholding is not enough to cover your estimated tax liability. Failure to pay either 90% of the current tax year liability or the safe harbor amount will mean needing to pay estimated tax penalties with your return filings. The safe harbor amounts 100% or 110% of the previous tax year liability, depending on your income level. There's some planning available around this as well. Is withholding is considered paid evenly throughout the year, and you can make up for a shortfall in estimated tax payments that were due earlier in the year by having additional withholding later in the year. Or if you had no real income until the last quarter of the year, you can use the annualized income installment method to reduce or eliminate estimated tax penalties. It's another planning strategy we use with some of our clients who don't want to make their estimated tax payments. Valid strategy as long as you have the withholding to make up for it. Quality record keeping is also extremely important. In case of audit from the IRS or Colorado, you must be able to quickly produce documentation which shows that any expenses you claimed were ordinary and necessary for your business and that they were directly related to your business operations. You must be able to provide that all deposits to your bank account were either recorded as income in your business, or you can show why they were recorded as something else. Having organized records can make the audit process so much smoother and much more likely to result in no changes from the auditor. I can guarantee your accountant will also thank you for making their job easier. The federal statute of limitations is 3 years, or it can be extended up to 6 years if fraud is involved or suspected. For this reason, we recommend keeping all your tax records for at least 7 years. Anything related to your business formation or large asset purchases, we recommend keeping indefinitely or for at least 7 years after the asset is disposed of. So we have listed some software that can help with record keeping. A lot of our clients like to use MileIQ to keep track of their business miles. Although some people will still keep a piece of paper in their glove compartment, that's completely valid. In fact, that's more likely what I would do because I'm a little less techy on apps. But for bookkeeping software, even though QuickBooks Online still needs a lot of improvement compared to QuickBooks Desktop, I do still think it's currently the best bookkeeping software available. Sage and Xero are also good choices. Sage is a little easier to make errors than in QuickBooks since it allows you to post parts of the same entry in different periods, which throws the trial balance out of balance. And Xero is, in my opinion, overly limited on what accounts you can make journal entries to. But if you can work around the limitations, they're good alternatives. We recommend writing the business purpose on your receipts for better documentation, and we recommend updating and reconciling your bookkeeping software at least monthly. This will allow you to see how your business is doing throughout the year really fast, and you will not be scrambling at the last minute to put together your records for your tax preparer. Most importantly, even if you outsource your income tax or payroll tax preparation, you as the business owner are ultimately responsible for your business taxes. It's your job to keep accurate records and review tax submissions to ensure their accuracy to the best of your ability. The IRS mostly won't let you claim ignorance if something is very poorly filed.
Lisa, one question here was, can you recommend a good desktop accounting system? It sounds like QuickBooks is a really good option based on what you said. Any other commentary on a desktop option?
Yeah, I absolutely love QuickBooks Desktop. I am very annoyed with them for trying to force everybody to the online version. They are keeping Enterprise. It's more expensive, but it's still good software. As far as I know, Sage is staying with their desktop version. I haven't heard what their online version might even be. So either of those do seem as to be good options for desktop. But again, Sage is a little easier to have mistakes as far as posting periods go.
Thank you.
So tax and human resource laws are complex and they are constantly changing. Again, as the business owner, you are ultimately responsible for your business, your tax liabilities and reporting requirements. So if you choose to outsource any of this administration, it's important to hire companies you trust to do the job correctly, to give you correct and timely advice, and to be willing to advocate for you in communications with government agencies. This will allow you to focus more on growing your business while allowing you to stay in compliance and take full advantage of the credits and deductions available to you.
In the words of Peter Drucker, a famous business consultant thinker, do what you do best and outsource the rest, and particularly in areas of high complexity or risk. No one wants the IRS knocking on their door. That's the worst.
Yeah, for sure. For sure.
On that,
Um,
Lisa did have a question about the IRS. How do they decide if fraud is involved, and at what point do they say, "Ooh, this is serious enough that we need to open an audit into this business"?
so a basic rule of thumb is they will assume fraud, or at least enough to start an investigation, if you omit 25% or more of your income. So they might catch that by somebody submitted a 1099 to the IRS showing that you had so much income, and then they say, hey, that doesn't match your tax returns. Um, or I'm not sure what else information they might have access to, but generally, if you omit 25% or more of your income, they might start looking into it to see if there's fraud involved.
Okay, so stay clean, stay clean.
Yes, yes, absolutely.
Well, if there's any more questions, please go ahead and put them in the Q&A. Thank you, everyone who's joined us today for your questions. And Lisa, thank you. Thanks for spending this time with us. I'll tell you, working with Lisa to prepare for this, she's put a lot of effort in trying to make these really complex, dense subjects very accessible. And I think, I know for me and for many out here, these resources, the recorded slides are going to be a huge asset. So Lisa, thank you so much. If you ever want to get in touch with Lisa and ClearPath or me and Obsidian, here is our contact information. Uh, as Lisa said, encourage you to reach out sooner rather than later, particularly as you're
Mm.
working on your tax strategies and your HR strategies for next year, because there's stuff that you got to do before the year starts to be ready to grow, whether that's the enterprise zone pre-certification or a million other things that could help you be ready. So, Lisa, thanks again for joining us. Thanks everyone who's joined us as attendees, and have a great rest of your day.
Thanks, Colby.